Faiz, I think you're on mute.
Thanks. Sorry about that. So I just said today's fact 4862, fact 4864, and welcome to today's lesson. We'll be covering IFRS 11 joint arrangements, and I'm just going to go through the theory in terms of giving you a high level understanding of the theory and how to think through the theory. Joint arrangements is not generally tested that extensively. What will most likely happen in your test 2 is that you're gonna have to discuss whether something is a joint arrangement, and or you're gonna have to discuss, if it is a joint arrangement, what type of joint arrangement. So you can probably go through the last 5 papers, test papers, and that question comes up every time. So part B is going to be a 10 to 15 mark question on joint arrangements. Very simple. So we're not going to go through a question on it. That's going to be your self-study to have a look at the required and then to answer the particular question. I'll take you through how to think through a question of that nature, and then it's for you to attempt. If you have any questions, then you submit it to me. So I'll tell you which question I want you to do for submission. I'll send it out on Friday. Then you can do it this weekend. Which question you have to do for submission, and you must upload it onto the platform, then I will look through it. In that way, you will also learn how to answer a discussion question, and I will provide feedback on that. Okay. So to jump into it, we're doing IFRS 11 joint arrangements. So there are basically 2 important aspects that you must first get right before considering anything else, before looking any further. The first thing, you need to identify whether you have a joint arrangement. And then the second thing is you need to know what is the definition of joint control. So a joint arrangement is a contractual arrangement that gives all the parties of the arrangement, or a group, meaning some of the parties, joint control over the arrangement. So that's important to understand. What is a joint arrangement? So a joint arrangement is an arrangement so a joint arrangement is a contractual arrangement. So there must be a contract in place that gives all the parties or some of the parties joint control over the arrangement. So that's important. Now, the next question is, so then what is joint control? Joint control is, you have joint control if in this arrangement, this contractual arrangement, there has to be a contract in place. So if this contractual arrangement gives the group of, give all the parties of the arrangement or some of the parties of the arrangement, the unanimous, so in order for them to make a decision, they need to unanimously agree. So basically, let's say there are 10 people in this arrangement. And if you read the contract, then let's say 5 out of the 10 parties have joint control. Okay, but what gives them joint control is that these 5 parties, in order for them to make a decision, all 5 of those parties need to agree. If one of them disagree, then the decision cannot be made. So that's the significant difference between normal control and joint control. When you have normal control, like a subsidiary, the subsidiary on its own, the parent on its own can make a decision regarding the subsidiary because he or she has sole control over the subsidiary. When it comes to joint control, if there's 5 parties, all 5 parties must agree. So they use the word unanimous, meaning there can't be any disagreement. So all must agree. Similarly, If you don't want to go ahead with something, all must disagree. So that is important. That is what gives you joint control. When you unanimously need the consent of all the parties of the contractual arrangement, or some of the parties of the contractual arrangement, regarding the decisions about relevant activities. So that's very, very important. So there's two things you need to be aware of. You fall into IFRS 11 if you have a joint arrangement and all the parties of the joint arrangement must unanimously consent regarding decisions relating to relevant activities. So it must meet both criteria. If it meets both criteria, now you fall into IFRS 11. Once you have established that you have a joint arrangement, because you have joint control, you now then have to decide what type of a joint arrangement do you have. There are two types. You can either have a joint operation or you can have a joint venture. So that's important to understand. So the exam will have two possible questions or both. So you will have to discuss whether you fall into IFRS 11, meaning whether you have a joint arrangement and whether you have joint control. Or it will tell you that you do have a joint arrangement because you do have joint control. Now you need to decide what type of a joint arrangement is it. Is it a joint operation or is it a joint venture? Or you must do everything. You must identify whether it is a joint operation, whether it is a joint arrangement because you have a joint control. So you have to discuss both joint arrangement and joint control. And then once you have concluded on that, you will then have to discuss what type of an arrangement is it, a joint op or a joint venture. So just take note of that. So remember, you can only have a joint arrangement if you have a joint control. You only have joint control if the decisions regarding the relevant activities needs to be decided upon unanimously, agreed upon unanimously by all the parties that have joint control. So remember, sometimes a joint arrangement can have 10 parties, but only 5 of them have joint control. Some of the cases, all of them will have joint control. So it doesn't have to be all the parties. It can be a group of parties as well. So for something to be a joint arrangement, it also there has to be a contract in place. So if there's no contract, there can't be, you don't have to consider joint control because you need a contract to be in place for it to be a joint arrangement. So just take note of that. And so you need two things for a joint arrangement. There needs to be a contract in place, and then the parties needs to have joint control. What gives something joint control? If they must unanimously decide regarding the relevant activities. So that's important to understand. You can read the standard very, very quick. It will take you probably 10 minutes to read the standard. So try to spend time on it. That's excluding our application Appendix B. Appendix B is the application guidance. That's a bit longer, but literally 10 minutes it will take you to read the standard of IFRS 11. Then when you have some more time, you read the application guidance. What's important, a lot of the answers is in the application guidance. So for example, the application guidance have 3 diagrams or have 2 diagrams and 1 table. The one diagram talks about whether you have a joint arrangement. So it takes you through a thinking process. When you write a discussion question, use that table. That's going to help you to, so not the table, use that diagram. That's going to help you to answer whether you have a joint arrangement. That's very important. The second diagram now comes into whether you have, now that you do have a joint arrangement, because you have joint control, what type of arrangement is it? A joint operation or a joint venture? A joint operation, you will have to consider whether the companies created a separate legal vehicle, a separate vehicle, or whether they did not create a separate vehicle. If they did not create a separate vehicle, like a separate company or a separate partnership, whatever, so they did not create a separate entity, the standard refers to as a separate vehicle, then it will be a joint operation. If they did create a separate vehicle, meaning a separate entity, then it will either be a joint op or a joint venture. So that's important. Once again, you use the diagram that they give you. The diagram will tell you whether or not the arrangement is a joint operation or a joint venture. The diagram starts by saying, is there a separate vehicle? If there's no separate vehicle, then it is a joint operation. If there is a separate vehicle, then it can either be a joint operation or a joint venture. So now the question is, if it is a separate vehicle, how do you decide whether it is the operation or whether it's a venture? There's a table that will help you to decide, also in the application guidance. So when you answer a theory question, you want to use the two diagrams and you want to use the table. The standard tells you that the way you decide whether an arrangement is a joint operation or a joint venture is by looking through, understanding the rights and obligations of the arrangement. So if the parties have rights to the actual assets and have obligations to the actual liabilities, then they will have a joint operation. However, if the assets belongs to the venture, if the operation, if the liabilities is the obligation of the venture, it is not the obligation of the investors, if I can call it that way. It is not, the investors don't have the right to the asset because the rights to the asset belongs to the venture, the separate entity, then it will be a joint venture. However, if those, even if it is a separate vehicle and the assets that is held by the separate vehicle, the parties have a right to those assets. And with the liability sitting in that separate vehicle, the parties have an obligation for those liabilities, then it will be a joint operation. But if the rights belongs to the venture, to the separate vehicle itself, if the obligations for the liabilities is the responsibility of the venture, the separate venture, the separate vehicle itself, then the parties will have a joint venture. So just take note of that. So they can give you on rights, which is rights to assets. They can give an obligation, which is obligations to liabilities. They can also refer you to income and expenditure. So if the entity, if the parties, the investors in this arrangement their profits is based on how much they have contributed to the venture, then it will be a joint operation. However, if they get a percentage of the net profits of the separate vehicle, then they will have a joint venture. So you might just have a look through those type of things. The table gives you quite amount of detail that will help you to actually answer a question. So it all comes down to basically three things. Number one, do you have a joint arrangement? If yes, you need to first then ask yourself, okay, do you have joint control? Joint control means all the parties that have joint control must unanimously agree or consent to a decision relating to the relevant activities of this arrangement. Then once you have joint control, you will have a joint arrangement, and now you will have to decide what type of an arrangement is it, an operation or a venture. How do you decide? It is based on the rights and obligations. So if the parties to the arrangement have rights to the assets and have obligations to the liabilities, then they have a joint operation. if the parties do not have rights to the assets, do not have obligations for the liabilities, because the rights to the assets belongs to the separate vehicle itself. The obligations, the responsibility of the obligations for the liabilities is that of the separate vehicle itself, then the parties have a joint venture. So you might just take that, understand that, and just understand why. Think about joint operation. The accounting treatment for joint operation from a group perspective is partial consolidation. The accounting treatment from a group perspective for a joint venture is equity accounting. Now, if you think about partial consolidation, the word consolidation is there. Where was that word? Where did we use that accounting treatment before? The treatment of the accounting treatment of consolidation fell in the range of a subsidiary when they had control. What does consolidation mean? That you bring on 100% of the assets, liabilities, income, and expenses on a line-by-line basis. Why did you do that? Because the parent have control over the type of assets. The parent have control over the type of liabilities they have. The parent have control of the revenue that they earn and the expenses that they incur. Therefore, you bring on 100%. Now, similarly with a joint operation, you have a joint operation when you have rights to the assets, when you have obligations for the liabilities, when you have an impact on the revenues. Because basically, your portion of the revenue is determined based on the amount you give, your capacity that you provide. So as a result, you kind of control that aspect. So therefore, we do consolidation. But we don't do 100% consolidation, we do partial consolidation. That means we bring on assets, liabilities, income, and expenses on a line-by-line basis, but only our percentage. So that's the difference. Similarly with a joint venture. A joint venture we equity account. Where did we do equity accounting as well? Under associates. What was associates? Associates, we only have significant influence on over the investee company. And only because we have significant influence, we have an associate, so we have to equity account. Equity accounting is all about bringing on your share of profits and then having an investment in associate. We don't bring on income and expenses. We don't bring on assets and liabilities on a line-by-line basis. Why? We only share in the net profits. Now, similarly with a joint venture, we don't have a right to the asset. We don't have a right, we don't have an obligation for the liabilities. Similarly, we don't have a right to the revenue and expenses. Our profit is based on the net profit of the associate. Our profit is not based upon how much revenue we contributed, but rather based on the net profit of the separate vehicle. And that is why with the joint venture, you apply equity accounting. So just try to see that similarity, try to see that link between joint operation, partial consolidation, and subsidiary, full consolidation. Joint venture, equity accounting, and associate equity accounting. See why those treatments make sense. If you compare joint operation to a subsidiary, you compare joint venture to a associate. And what are you comparing? So you know the accounting treatment for joint venture is equity accounting. Why? Because based on the rights and obligations, they only have a right to the net assets. They don't have a right to the individual assets and liabilities. Whereas with a joint venture operation, we bring on assets, liabilities, income, and expenses on a line-by-line basis. Why? Because we have rights to the individual assets. We have a responsibility, we have an obligation for the individual liabilities. So just take note of that. So that is basically IFRS 11, the key principles of IFRS 11. I basically covered, if you read IFRS 11, I've basically covered all the bold sections of IFRS 11. You can read the non-bold, which just gives you some further detail. Once you have that big picture view, then you move on to the application guidance, Appendix B. Remember, what is part of an accounting standard is the actual standard, is Appendix A, the definitions, and is Appendix B, the application guidance. So remember, that is part of an accounting standard. If something is part of an accounting standard, then you can use it as an argument when you discuss a theory question. For example, illustrative examples are not part of the accounting standard. It's not part of the standard. It's just an illustrative example. So you can't use an illustrative example as your main argument. You can only use an illustrative example as supplementary support for your argument. So that's very important to understand. So the application guidance is the main section you want to get through, because that is where you're going to get all the details on how to apply what the standard is saying. But as a starting point, just always read the standard, because it's short and it gives you a big picture view of what is required. But to really understand how to apply what you just read, you go to the application guidance. The application guidance are very detailed. I'm not sure exactly for IFRS 11, I can't remember, but like for IFRS 10, IFRS 3, it's very detailed. So you're generally going to read it for the whole year. So that's why I first just read the standard as a starting point. I hope you guys are getting your books. So so like I'm saying, I've covered basically the bold of the standard. Then I touched on 3 aspects of the application guidance, which is the diagram to decide whether you have a joint arrangement, a diagram to decide whether you have a joint operation or a joint venture, and then a table to work through rights and obligations, revenue and expenses to determine whether you have a joint operation or whether you have a joint venture. So that's all I wanted to cover for today. As a self-study, because it's not a hectic topic, that is why I'm giving you as self-study, is that you must do work through, you in 1 weekend, you can work through 5 questions, but it's so short, literally short. What I used to tell my students, read the scenario, first go through a theory, right? Like 10 minutes, read the theory, get a big picture view of the theory. Read the scenario, read the required, answer it in your head, and then look at the solution. Look at the solution and see how you fared. If you want to be more diligent, then write down your answers first and then compare to the solution. You should be able to do 5 in 1 day because it's so short. And then you will pick up the key things they bring across. So they'll generally bold what is the important stuff to bring across. And then all you need to see, okay, those are the key things. So there's generally, like, they can tell you, they're going to highlight, they can put in bold. A joint arrangement is a contractual arrangement. That's the one. Second thing, a joint arrangement is a contractual arrangement that gives all the parties or some of the parties joint control. The word joint control will be in bold. Then they will explain what is joint control. Joint control gives all the parties or some of the parties to the arrangement. Joint control for the parties or for some of the parties is when these parties must unanimously consent relating to decisions about relevant activities. So that unanimously consent will be in bold and relevant activities will be in bold. So now you already get an idea, okay, those are the key things I need to discuss. Then the next thing is, now that you know the key things you have to discuss in the various questions, is now to apply it to the actual scenario. What tells you that there is a contractual arrangement? What tells you that there is joint control? What tells you that they have to unanimously consent regarding decisions about the relevant activities? What tells you that? Link it to the scenario. Then you go on to, now that you have a joint arrangement, because you have joint control and you have and there's a contract in place, now you need to discuss what type of an arrangement, joint op or joint venture. The first thing you need to discuss is whether there is a separate vehicle or not. If there is no separate vehicle, it is a joint operation. Now, if they want to keep it very simple, they're going to do that. If they want to make it a little bit more complex or a little bit more detailed, they're going to give you a separate vehicle. Now, if there is a separate vehicle, it could either be a joint operation or a joint venture. So now how do you decide? Now you have to talk about the rights and obligations. And then you will have to talk about the rights and obligations. You have to talk about the revenue and the expenses. Are the profits earned? So when it comes to rights, it's talking about assets. When it comes to obligations, talking about liabilities. When you're talking about the revenue and expenses, we're referring to profit. Is your profit based on the capacity that you provide, or is the profit based on the net profit of the separate vehicle? If it's based on the net profit of a separate vehicle, it's a joint venture. If your profit is based upon what you have provided in terms of capacity towards revenue, in terms of the output of revenue, then you have a joint operation. You will have a look, they will bold the capacity, they will bold net profits, they will bold rights and obligations. Now you have the big picture view of what are the key things that you always need to discuss. The next thing you just have to do is how do you relate those key things to the actual scenario. Something in the scenario will tell you whether the parties to the arrangement have a direct interest in the assets or not. Something in the scenario will tell you that the parties to the arrangement have an obligation for the individual liabilities or not. Or they will tell you regarding that their profit is based upon the level of output of revenue that they have contributed. So let's say they produce 1,000 units. Of the 1,000 units, your entity contributed 400. So therefore, your revenue, your profit is based on the 400 that you have contributed. That means you have a joint operation. However, if your profit is based upon the net profit of the vehicle at your percentage, then you have a joint venture. Something will tell you that. But what you need to know is get the key issues you need to look out for. And I made mention now of the key issues. And then from there, you need to document. So that's basically what we wanted to cover for tonight. So your homework is to do 3 to 5 for your own. I will tell you which one I want submitted on the website. I will send you an email with the question I want to be covered, and then there'll be a link that you will have documented and you must upload. And then I will read through it. What I will look is what you answered in terms of the theory, and then how you answered to help you structure a theory question. Okay. Do you have any questions? That's all from me from tonight. Do you have any questions? Faid, Fakir, Rebecca?
No questions.
Fakir.
No questions.
Okay. Rebecca, nothing. Okay, so that's all from me for tonight. Next week, we're doing, or for Mac, we're doing mergers and acquisitions. Not too hectic. So we're going to do mergers and acquisitions next week. We won't have many questions to do because the questions is going to be based on once we come to valuations. Okay, so we won't have too many questions for Mac next week either, because we're really going to do questions when we come to valuations. So we have 2 weeks of valuations. The second week of valuations is just questions. There's no theory. Then for FAC 4861, 4863, we're doing financial instruments. Huge topic, significant topic. Don't underestimate financial instruments. You must know it inside out. Thereafter, we have share-based payments. And in the 4th week, we're going to do some more questions, just questions on financial instruments and share-based payments. For those that are doing FAC 1, so FAC 4861, CT1, you don't do share-based payments. You will just get extra questions for financial instruments. Then for FAC 4862, 4864, we have joint arrangements, easy. Then we have revenue. Revenue, not so easy. Revenue can be quite complex, but we have 2 weeks of revenue. So we will take our time. 1 week will be hectic on theory, but we'll also do questions. And then the second week, we'll just do questions. I'm going to try to get, I want to try to let you cover the various types of questions because there's too many. And then part of your homework for revenue when we get there, in IFRS 15, IFRS 15 illustrative examples, not part of the standard, but it is illustrative examples. There's about 69 illustrative examples. Your homework is going to be to read through all 69 because many of the questions of revenue comes from the illustrative examples and all the answers is in the illustrative example. So if you have covered the illustrative example, you'll be able to answer most questions that's going to come your way. And if you still don't know how to do it, when you get it in the exam, at least you know it's there. So when you go read through it, you have an idea about it. So I'm telling you the answers to a lot of the revenue questions is in the illustrative examples. So there's 69 of them. So you're going to go through all 69. You will read it in a day. It's going to take you probably like 1 hour, 2 hours to read. It's not long because 69 just means you will see. So you need your books for that, eh? The illustrative example is in the books. So a lot of the revenue questions come from there. I've done a few revenue questions from UNISA and almost half of them came from the illustrative examples. So just make sure you have that book. Then the last part of Fact 4862, Fact 4864 is related parties. We will cover that very quickly. Okay, so I'll see you guys next week. On Friday, I will share with you what you need to submit for joint arrangements. Okay. Cool. See you guys. Bye-bye. No questions? Still no questions? Happy? If you're happy, you're good to go.